Last week, I showed you a couple who brought in $80,000 and paid the IRS about $70. This week, I'm going to show you a couple who brings in $130,000 and pays the IRS zero. Not $70, zero. And they didn't touch a thing. They didn't touch a Roth conversion to get there. They didn't do any kind of magic. I just want to show you what is being missed in what I'm seeing. For those of you who don't know me, my name is Chris. I'm a CPA here in Texas, and I've been doing this for 30 years, over 30 years, and I do it day in and day out. So I want to show you this step by step, line by line, right here on screen. Here's the answer up front. None of this waiting. If you want the answer. This isn't one trick. It's two things stacked on top of each other. The first is a tax-free floor. We've built this last week. We talked about this last week. The standard deduction plus the senior deductions, if available, $47,500. For a married couple, both over 65, that's the amount. The second is a bracket almost no one talks about, and that's the 0% long-term capital gains bracket. There are two levers, the $47,500 level and the 0% capital gains bracket. So those levers are really what matters. So as a recap, 30 seconds for anybody just joining. For a married couple, both 65 or older, taking the standard deduction in 2026, the standard deduction itself is $32,200. The age 65 add-ons is another $3,300. And the new senior deduction from the One Big Beautiful Bill adds $12,000 to a married filing joint return. Added up, $47,500 worth of income the IRS never touches. That's lever one. It is fully explained in my last week's video. Go back and watch that if you didn't. Fact, $32,200 plus $3,300 plus $12,000 is $47,500 tax-free floor for married filing jointly, both 65 plus. Now, lever two, where it comes into play, this is the one that surprises people. Long-term capital gains, profits on investment that you've held more than a year, get their own tax bracket, completely separate from your ordinary income tax brackets. They have 0, 15%, 20%. For a married filing joint couple in 2026, that 0% bracket runs all the way up to $98,900 of taxable income. Here's the part that trips people up. Capital gains stack on top of your ordinary income, not underneath it. So it's not $98,900 of just gains. It's your ordinary taxable income plus your gains together that has to stay under that line for the gains to be free. All right, another fact. Long-term capital gains bracket, married filing joint, taxable income up to $98,900, gains stack on top of ordinary income. And before anybody asks, no, this isn't a Roth conversion with extra steps. A Roth conversion solves a different problem. Money trapped in a pre-tax IRA that's eventually going to be forced out at a worse tax rate, or forced out by required minimum distributions in a worse tax rate. This strategy solves an entirely different problem. It's for money that's already sitting in a regular taxable brokerage account outside of any retirement. So we're not talking about a retirement account. If that money's never been in an IRA, there's no distribution to force and no conversion decision to make. Different account, different tool. Let's make it real here. So let's use Ray and Peggy, not their real names, of course. Both 66, retired in Texas. Between them, $50,000 a year in Social Security. On top of that, they spent 30 years building up a regular brokerage account. Stocks, old stocks bought years ago, way outside any IRA. This year, they need $80,000. Now, this doesn't mean you can't have an IRA, but we're talking about activities that we can influence within an already taxed account, not a pre-tax, before-tax account. This year, they need $80,000 of that account to round up their spending. And because they've held those shares so long, Almost all of it's long-term capital gain. Almost all of it is capital gain. Add it up, $50,000 plus $80,000 is $130,000 in the door. Guess what they owe? Both 66, Social Security $50,000 plus the brokerage sale, long-term capital gain $80,000, $130,000 total. So, step one is same as always. Provisional income, half their Social Security is $25,000. Their other income, and yes, that's $80,000 in capital gains, counts here. Even though we're about to show it gets taxed at zero, $80,000 goes into the calculation of their provisional income. Add those 105 of provisional income, $105,000 of provisional income. That's way over the $44,000 married filing joint, the threshold. So we're in the top zone. Run the actual worksheet, not just 85% flat, and it comes out to $42,500 of their Social Security being taxable. All right. So let's look at that. Provisional income, $25,000 plus 80 is $105. Over $44,000 line, taxable Social Security, $42,500. Step two, total income subject to tax. $42,500 of taxable Social Security plus the $80,000 in capital gains is $122,500. That's their adjusted gross income. Now bring in the floor from lever one, the $47,500. Their only ordinary income is that $42,500 of taxable Social Security. And the floor is bigger than that. It wipes it out completely with $5,000 of floor left over. Next step. And here's the thing that people miss. That leftover $5,000 of floor, of that taxable floor, doesn't just disappear. It rolls forward and reduces the capital gains sitting on top of that. That's the $80,000 in gains minus the $5,000 in unused floor, leaves $75,000 of taxable income. And every dollar of that $75,000 is capital gain, taxed under that second lever, lever two, not lever one. Check it against the ceiling. What was that ceiling? $98,900. They're under it by $24,000. Every dollar taxed at zero. So let's go through that. $80,000 long-term capital gain, $5,000 leftover floor, left $75,000 taxable capital gain. It's under the $98,000 ceiling of that separate capital gains rate structure, taxed at zero. So the result, total income in the door, $130,000. Federal tax owed, zero. Not 70 like last video, zero. And Ray and Peggy didn't convert a single dollar to a Roth. They didn't do anything exotic. They just drew up their income from the right account, in the right order. That's where the numbers lined up. So there it is, $130,000, no Roth conversion involved, no hoops, no circus tricks to perform, none of that. Now, three things have to be true for all of this to work. I want to be straightforward with you about all of them. One, you actually need capital gains sitting in a taxable account. Doesn't work if all your money's in an IRA or 401k. Two, it only stays this clean while your other ordinary income stays low. A $30,000 pension check would have eaten up most of that floor before the gains ever got a chance at it. Three, once required minimum distributions start at age 73, the IRS forces ordinary income out of your IRA, if you have one, whether you want to or not. And that can crowd this whole strategy. So there's a window that most retirees get for a handful of years that lets this occur, and this can last forever. Another fact, requires capital gains in a taxable account, low other ordinary income. The window narrows once required minimum distributions start. So there's the takeaways from that. One more move, and this one applies even if you're not pulling a dime out of your account this year. If you've got long-term capital gains sitting in a taxable brokerage account, stocks bought years ago that have grown, You don't have to wait until you need the cash to use this bracket. You can sell some of it every year, up to that 0% ceiling. Pay nothing. Turn around, buy it back if you want, as long as you wait and avoid the wash sale rules. By doing this, what you've actually done is reset your cost basis higher. It's during your life, which means less gain and less tax whenever you do eventually sell. That's if you repurchase. So, to be clear, because I don't want anybody doing something dumb over a tax rule, remember, economic decisions are up here. Tax decisions are farther down the list. You would love to incorporate both of them in the ideal situation, but don't go make bad economic decisions just to satisfy some tax rule. Now, don't let the tax tail wag the investment dog. Just don't do it. But if you already own it and you're going to keep holding it anyway, there's no reason to leave that 0% room sitting on the table year after year. If you just sell and buy the same thing back, you're still invested, still growing. For a married couple, depending upon what else is on the return, that's often somewhere in the $75,000 to $90,000 range of gains. You can wipe out a lot of significant gains by utilizing this practice and just planning. So sit down with your advisor before year end each and every year. I hope you got value from this video. If I can help, just post the question down in the comment. I'm not going to give you specific advice, but I can give you general direction and maybe answer a lot of general questions. So, as usual, I appreciate you watching this video, and we'll see you next time.